Welcome back, everyone. This is the fourth lecture in the series, and today I'm going to start with the second section. In the first section, I gave you an overview of the three financial reports, which are balance sheet, income statement, and cash flow statement. Today, we are going to start with the analysis section and see how these reports are analyzed. Before we move on to the analysis of financial statements, I would like to give you a little practice on interpreting these statements and see what kind of mistakes people do while reading the financial reports. I have shortlisted three companies. One is an infrastructure company, another is a consumer products company, and the third one is a housing finance company. Let's see what are the core differences between these companies, what should be the alarming signs, and what should not be so alarming. The first company that we are going to talk about today is an infrastructure company. The first report that you will come across while reviewing any company is the balance sheet. In this balance sheet, you can see that the top portion comprises of equity and liabilities, and the lower portion comprises of assets. Let's look at the first component, which is share capital. As you can see that the share capital has remained consistent over the last 5 years, and only in the last year some new capital has been issued, because you can see that the capital has slightly increased in the last year. You would also notice that the company has enough reserves. And how does the company get these reserves? As you would recall, I told you that some companies in the initial phases do not distribute dividends. In fact, they keep them in the company as reserves to be re-employed in the company. The reserves in this company have increased over the last 5 years. And then finally, you should have a look at the debt section. You can see that the debt of this company is huge. Usually, it would be alarming. But it should not be alarming in the case of an infrastructure company, because infrastructure companies are capital intensive companies and they require a lot of funding. So the funding may come from either share capital or it can come from debt. We can also see that the debt has increased over the past few years. So in case this is a company which is still expanding and which of course has positive operating cash flows, which we'll come to see later on whether it has or not, then this should not be a very alarming figure. Let's move on to see what we should look at in the assets side. This top portion comprises of fixed assets. And as you can see, these assets are being depreciated. While this is the original value of the asset, after depreciation, the book value of the asset has reduced. Then this company also has some regular current assets, which include inventory, debtors, cash balance. And as you can see, the inventory of this company has increased drastically as compared to the previous years. This can indicate a problem with sales. One is that the company is not able to make enough sales, so it has idle inventory lying with it, or the sales have increased drastically over the past couple of years, and in anticipation of future sudden changes, the company has accumulated inventory so that it does not fall short of the requirement. It does not fall short on the supply side. So we will see what is the case as we move forward to the profit and loss account. There is no more on this balance sheet that I would expect you to be worried about. So our only takeaways are that first we should look into the increasing debt. Unless and until the company is expanding, its sales are increasing year on year, it has positive operating cash flows, we should not be worried about it. Next, we also have to look at the inventory status. Is the revenue of the company increasing so much that the company really needs to keep that much of idle stock with it? So let's see what the profit and loss account tells us. This slide shows us the profit and loss account of this company. So we can see that the first line is sales turnover. And the sales turnover was consistent for the past 4 years. However, in the last year, it went down. So it wasn't drastically increasing as we suspected when we saw a huge amount of inventory. So that is not a good sign, because while the sales have been constant, they have dropped in the last 1 year, and still that does not justify the difference in the increased amount of inventory that is showing on the balance sheet of this company. Then there are also other incomes and stock adjustments. I would not look at these very keenly because they are not coming from operations. I'm most interested in this figure here. The next thing that you need to look at is the expenses. This line is the total expenses of the company. And as we can see, the company has been able to contain its expenses over the past year. And in fact, it has reduced its expense in the last year, which is a good sign, because in the increasingly competitive world, we want to have control over our expenses. Let's see what caused this decline in expenses. The biggest contributor of this decline is other manufacturing expenses. So the company has been able to reduce its manufacturing expenses drastically, which is a good thing. If you come down to the lower section, you will see that this line here shows the operating profit. The operating profit has dropped in the last 1 year, while in the 4 previous years it was quite consistent, but in the last 1 year it has dropped drastically, but it is still positive. We would primarily be concerned with this top section because it covers operating incomes and expenses. The lower section after operating profit comprises of non-operating expenses and non-operating incomes, which includes interest. Interest is one of the biggest expenses for this company because we saw how huge the debt outstanding is for this company, and while servicing this debt it has to pay interest. So interest is one of the biggest non-operating expenses for this company, and it leads to this company having a negative net profit. So if you look at the last or the bottom line of this company, you can see that while the net profit has been reducing year on year, it has remained positive till the previous year. Just in the last year, it has turned negative. So it is really not a good sign for a company when it shows that historically its net profit is going down. So it is going down consistently, and finally it has fallen in a negative category. However, we should still not make any final decision about this company before we look at the cash flow statement. Well, this is the cash flow statement of this company. And as you can see, in the last year, the net cash flow from operating activities was positive. And in fact, it was much more than the previous year. This company has had a positive operating cash flow for its recent history that has been given. And this is a really good sign. It is the sign of a company which is able to sustain its operations. It is able to generate enough money from its operations to fund all of its operating expenses. We can also see that the company has made certain investments, and it has also tried to repay some of its debt. So which is again a positive sign. As we can see, in the previous years, the company has been raising debt all through. However, this is the first time on when the company has tried to repay some of its debt. So it is again a good sign. So even though this company has had declining net profits and finally going into negative phase, the best part is that it has got positive operating cash flows and it has started repaying its debt now. We saw that the company is not facing operational difficulties. However, the huge amount of debt that it has, that is what is causing net profit to decline, because it is one of the biggest non-operating expense of the company. But if this company continues to repay its debt, probably it will become better in the next couple of years. So you should keep it on your watch list and keep following it. Next, let me take you through a consumer products company. The reason that I specifically chose this company for you was because I wanted to give you a different view of a company. This company is very different from the previous company that we reviewed. And one of the primary reasons is that if you look at the debt of this company, you will see how less it is. Now, this is not a capital intensive industry, so you do not expect it to have a lot of investment or to have the requirement to raise a lot of money from the market. So we can see that its share capital has remained consistent, though it raised some new capital in the year 2013. It has also been keeping its reserves in order to re-employ them back into the business, and it has a small debt. Let's look at the asset side. In the asset side, again, this portion, as I told you in the previous balance sheet, is the fixed assets. We can see that the company has increased its hold of fixed assets over the last couple of years, and this shows that probably it is investing in latest technology or it is expanding its business. Let's also have a look at its current assets. The inventories have stayed more or less consistent in the past few years. Debtors have gone down from the previous year, which suggests that the company has been able to make more collections. Cash and cash balances have also gone down, which means that the company has been able to utilize the available cash balances with it. And well, that is really all that you need to look at over here. Let's move on to review income statement. The income statement of this company is looking quite promising. As you can see, its revenues have increased consistently over the past few years. As the revenues have increased, we can also see that its expenses have increased in line with the revenues. And finally, when you look at the bottom line has also increased consistently over the past 5 years. You can see that there is no drastic jump. It is very consistent, though in the last year it came down slightly. I hope we see a positive effect on the cash flow statement as well. Let's look on to see how the cash flow statement is doing. As you can see, the operating cash flows are increasing consistently over the past few years. They dipped in 2014, but again they came up a big way in 2015. The company has also invested in new equipment in the past couple of years, as we had noticed in the balance sheet. And finally, the company is trying to repay its debt, which is a very good thing, because as we noticed in the previous company that we were discussing, the higher the debt of a company, the more it spends in servicing it in order to pay its interest. So it is beneficial for a company. If it does not require the excess debt, then it should try and dispose of it. So we can see that the company paid off some of its debt. Let's confirm this by going back to the balance sheet. So as confirmed by our cash flow statement, we can see that the company has been paying off its debt over the past few years, which is again a good sign. The company has also reduced its interest payments, as you can see, over the last few years, because it has been repaying its debt. So while the net increase in cash over most of the years for this company has been negative, that should not be a cause of worry, because we know that first it is generating positive operating cash flows, and second it is using its cash to pay off its debt. Let's move on to reviewing the last company of the day, which, as I told you, is a housing finance company. This is the balance sheet of the housing finance company. Again, because the nature of this company is that it is in the finance sector, like a bank, it can only sustain if it takes investments from people and then employs it in other financial activities. And therefore, this company again will have a lot of debt, and that should not be a point of worry till it can still have positive operating cash flows and a positive net profit even after servicing its debt. We can see that this company has a small equity portion. However, it has a huge amount of debt in it. However, the debt has consistently increased over the past few years. So we know that what negative impact it can have. First, it can negatively impact our net profit by eating up on the operating profit and giving a negative net profit figure at the end of it. And second, we do not want this company to be raising this debt in order to fund its operations. So for this company, it is more important to have a good positive operating cash flow. Because it is a finance company, we do not expect to see a whole lot of fixed assets on it. So this is fine. Again, because this company does not need to deal in products, it does not need to have any inventory. So you would see that the inventory is zero all through. But because it is in the finance sector, it takes money from the public and it also loans to public. It would also have a huge amount of loans and advances. Moving forward to looking at the profit and loss account of this housing finance company. As you can see, this company has positive sales turnover for the last 5 years, and rather it is increasing, so it is really good indicator. But again, you cannot rely on revenues unless and until it is accompanied by an equally positive operating cash flow. We can see that this company keeps its operating expenses less. However, its non-operating expenses, which are its interests, are huge and they have been increasing, as you can see, because the debt of this company has been increasing over the last few years. And finally, we can see that despite of servicing its debt, this company has been able to maintain a positive net profit position. Again, the positive net profit has been increasing over time. So over the last 5 years, both the operating profit, this line, and the net profit, this portion, has increased over the last 5 years, which is a very positive sign. But I would still not just rely on it unless and until I see the cash flows. Let's move on to seeing the cash flows of this company. Now, this is what I call a big alarm. As you can see, even though the company showed that its revenues have been increasing and it had good amount of revenue in the last year, you do not expect it to have this on its cash flows. It has a huge negative cash flow which needs to be looked into. We can also notice that in the past 4 years, though the operating cash flow has increased, it has not increased in line with the increase in revenue. The revenue increase was in thousands, but the increase in operating cash flow is in hundreds, which is a huge difference. It is a big red flag. It needs further investigation before a person decides to invest or proceed with further analysis into this company. We can also notice that this company raised new debt in the last year, and the new debt it has raised is in line with the operational deficiency. Now, this is something which is very awkward, and we do not want to get into a company which raises funds from the market to just run its operations. So, well, that is a big alarming sign, and this is what I wanted to focus upon, and this is what I wanted to bring your attention to. This information was nowhere to be seen in the balance sheet or in the income statement. However, it is very apparent in the cash flow statement. A company that raises debt or money from the market to fund its operation is not where you want to invest. You want to invest in a company which raises funds to expand, to grow. And that is the information that you get from the cash flow statement. So, well, I guess that this information is sufficient for you to digest. Take your time to understand what I took you through in this lecture. And in the next lecture, we will do the analysis. I will take you through comparative statements and common size statements, which are the tools that you need to analyze the financial statements. Thank you very much.